Good early morning, everyone. T-Speaker 222 XRP Future Millionaire with the side bet on XRM and Future Digibyte OG. So I want to thank you guys for coming back to the overnight radio show. It's 3:42 a.m. Eastern Standard Time. We are doing the Wyckoff Schematics part 2 of 3 as we break down. If you didn't see the first one, which only just about 200 people viewed it, which hopefully these overnight radio shows will get more popular, but I really like the audience that tuned in. I appreciated the feedback, and because of your guys' feedback, and I know you watched the entire thing because I asked some questions that you answered, I'm willing to do this again and take up some time and read this because it's a lot. But I believe the more we all know and learn together, the more we'll understand. So we went through the introduction, and we ended down here at distribution. So today I want to go from distribution and end down here, and we'll end at the Nokia chart 2. So we're going to go through the next 2 pages of the diagram. So the distribution, schematics 2 and 3, represent 2 variations of the Wyckoff model of distribution. While these models only represent 2 variations of the many possible variations in the patterns of a distribution trading ranges, they do provide us with the important Wyckoff principles often evident in the area of distribution and the phases of a trading range that can lead us toward taking a speculative position. Much of the analysis of the principles and phases of a trading range preceding distribution are in the inverse of a trading range of accumulation, and that the roles of supply and demand are reversed. So, let's see what schematic 2 is all about. Here, the force of jumping the creek resistance is replaced by the force of falling through the ice support. It is useful to remember that distribution is generally accomplished in a shorter time period than accumulation. So, schematic 2, distribution schematics. Schematics 2 and 3 show us 2 model variations of distribution trading range, phase A through E. Phase A through here. Phases through which the trading range passes as conceptualized by the Wyckoff method and explained in the text. Preliminary supply is where substantial selling begins to provide pronounced resistance after an up move, volume and spread widen and provide a signal that the up move may be approaching its end. Buying climax is the point at which widening spread and the force of buying climaxes and heavy or urgent buying by the public is being filled by larger professional interest at prices near a top. Automatic reaction with buying pretty much exhausted and heavy supply continuing an AR, which would be an automatic reaction. So, blah, blah, blah. Because we're going to have to remember all this, guys. So, automatic reaction with buying pressure, secondary. So we had an automatic reaction followed by a buying climax with buying pretty much exhausted. So the low of this sell-off will help define the bottom of the trading range. Secondary test, revisit the area of the buying climax to test the demand-supply balance. At these price levels, if a top is to be confirmed, supply will overweigh demand and volume and spread. Where we at? Spread should be diminished and the market approaches the resistance area of the buying climax. Sign of weakness at point 10 will usually occur on increased spread and volume as compared to rally to point 9. So point 10. Oh, that's back at the top. So yeah, let's continue. You guys can look through this on your own time. Obviously, you can pause and look through this. I'll move around. At point 10 will usually occur an increased spread and blah, blah, blah. Forge ahead. The ice is an analogy to wavy line of support drawn loosely under reaction lows of the trading range. A break through the ice will likely be followed by... Actually, we're going to do this 1 page at a time so we can focus so we don't rush through. So we'll do 1 page today, 1 page tomorrow. Will likely be followed by attempts to get back above it. A failure to get back above firm support may mean a drowning for the market. Last point of supply, schematic 2.11. After we test the ice support on a SOW, so that's, what is that? That is a strength of something. or sign of weakness. So, support or sign of weakness, a feeble rally attempt on narrow spread shows an effort, shows us the difficulty the market is having in making a further effort. Volume may be light or heavy, showing weak demand or substantial supply. It is at the, let's see, what the fuck is this one? It is at the last point of supply that the last waves of distribution are being unloaded before a markdown is to begin. Schematic 2.13, after a breakthrough, the ice, a rally attempts is thwarted at the ice surface. Now resistance, the rally meets a last wave of supply before a markdown ensures. So let's see. Last point supply are good places to initiate a short position or to add to an already profitable one. Up thrust and after distribution. See schematic 3.11. So we have to go to the other one. Here's all the points. 3-11. So there's the ice, that's the support line, and then it breaks below the support line on this one. So, similar to the good place to initiate. So in terminal shakeout, so similar to the spring and terminal shakeout in the trading range of accumulation, a UTAD, so what the fuck's a UTAD? I can't remember what that one is either. Up thrust after distribution may occur in a trading range or distribution. It is more definitive test of a demand after a breakout above the resistance line of the trading range and usually occurs in the latter stages of the trading range. If this breakout occurs on light volume with no follow-through or on heavy volume with the breakdown back into the center of the trading range, then this is more evidence that the trading range was distribution, not accumulation. This up thrust after distribution usually results in weak holders of short positions, giving them up to more dominant interest and also in more distribution to new, less informed buyers before a significant decline ensues. So phase A, we're going to go through phase A, B, C, D, and E, and then we'll call it a day, and I will let you guys go because I don't want to overdo it, but I want to make sure you guys come back day after day because you guys need to know this, and then we'll go over the gold market real quick at the end. So phase A. In a phase A, demand has been dominant. So the source, so in schematic 2, we see what's going on. Source, The Anatomy of a Trading Range by Jim Forte. So Market Technicians Association Journal, issued 1994. So phase A. In phase A, demand has been dominant, and the first significant evidence of demand becoming exhausted comes at point 1 at preliminary supply and point 2 at the buying climax. Schematics 2 and 3 show this. It often occurs on widespread and climatic volume. This is usually followed by an automatic reaction and secondary test of the, let's see, because we want to remember all the definitions. The buying climax, can't forget those climaxes, ladies and gentlemen. Oh no, well, Tom, are we sure we're talking about the Wyckoff? Well, it kind of makes sense, right, Bob? All right, Bob, we got to continue. Usually on diminished volume, this is essentially the inverse of phase A in accumulation, as the accumulation phase A is distribution, may also end without climatic action, which happens often, huh, guys? Actually, the women know more about that, don't they? Cheap shot at the male audience. No, I'm just kidding. Only evidence of exhaustion of the demand is diminishing spread in volume. Where redistribution is concerned, a trading range within a large continuing down move. We will see the stopping of a down move with or without climatic action in phase A. However, in the remainder of the trading range, the guidance, principles, and analysis within phase B through E will be the same as in a trading range of a distribution market top. Phase B, the points to be made here about phase B are the same as those made for phase B within accumulation, except clues may begin to surface here of the supply-demand balance moving toward supply instead of demand. Phase C, one of the ways phase C reveals itself after the standoff in phase B is by the sign of weakness shown at point 10 on the schematics. So point 10 right there, you see the sign of weakness. Well, actually, so there's point 10, the sign of weakness. So let's go back. So it usually accompanied by significantly increased spread and volume. To the downside, and that seems to break off the standoff in phase B. Okay, so that's phase B, and it breaks up just a tiny bit when you get into phase C. The sign of weakness may or may not fall through the ice, which it obviously did when we got the part E on the schematics. On schematic 3, in the E section, it fell through. But the subsequent rally back to point 11, a last point of supply, is usually unconvincing and is likely to be accompanied by less spread and or volume, which is exactly what we're going through now, guys. Let's face it, this is exactly what we're going through right now. Point 11 on both distribution schematics 2 and 3 give us our last opportunity to cover any remaining longs, and our first inviting opportunity to take a short position. An even better place would be on the rally testing point 11, because it may give us more evidence, diminished spread and volume, and or a more tightly defined danger range or danger point. An upthrust is the opposite of a spring. It's when you inject Viagra. It helps the man please the woman. No, I'm just kidding. Let's continue. It is a price move above the resistance level of a trading range that quickly reverses itself and moves back into the trading range. An upthrust is a bull trap. And what have I talked to you guys about? I've talked about you. I'm going to have to go hashtag upthrust, because it is in fact the bull trap I always warn of. It appears to signal the start of an uptrend, but in reality marks the end of an up move. The magnitude of the upthrust can be determined by the extent of the price move to new highs and the relative level of volume on that movement. Looking now at scheme 3 phase C. So scheme 3 phase C, now we're in that little up move, which is the bull trap itself by pronounced move upward, breaking through the highs of the trading range. This is shown at point 11 as an upthrust after distribution, like the terminal shakeout discussed earlier in the accumulation schematic. This gives a false impression of the direction of the market and allows further distribution at high prices to new buyers. It also results in weak holders of the short position surrendering their position to stronger players just before the down move begins. Should the move to new high grounds be on increasing volume and relative narrowing spread, and then return to the average level of closes of the trading range, this would indicate lack of solid demand and confirm that the breakout to the upside and did not indicate a trading range of accumulation, but rather a formation of distribution. A third variation not shown here in schematic form would be an upthrust above the highs of the trading range with a quick fallback into the middle of the trading range, but where the trading range did not fully represent distribution. In this case, the trading range would likely be too wide to fully represent distribution, and there would be a lack of concentrated selling except in the latter portions of the trading range. This is fascinating. Phase D arrives and reveals itself after the test in the phase C. Show us the last gasps, or the last hurrah of demand. In phase D, the evidence of supply becoming dominant increases either with the break through the ice or with a further sign. What is that? A sign of weakness? I think that's sign of weakness, SOW. But guys, we got to remember all the terminology. Remember this. It's important. So, where the fuck are we at? So where's our sign of weakness? Well, it might not even be sign of weakness. Ah, sign of weakness. Look at that. See, we're already learning, guys. Sign of weakness. Make a man feel good. So let's see where we at. Sign of weakness into the trading range after an upthrust. In phase D, we are given more evidence of the probable direction of the market and the opportunity to take our first or additional short position. Our best opportunities are at point 13, 15, and 17. So 13, 15, and 17. That'd be great spots. 17 is probably one of the better positions because that confirms that we're going to be on a downtrend because that was the last ditch effort, but we had no volume. 15 is also a good spot, and 13 would be if you have a keen eye and you taking a gamble because sometimes it'll move to the upside after a quick drop to support. So I definitely agree with this 100%. So as represented on schematic 2 and 3, these rallies represent last points of supply before a markdown cycle begins. Our averaging of the set positions taken within phase C and D as described above represent a calculated approach to protect capital and maximize profit. It is important that additional short positions be added or permitted only if our initial positions are in profit. In phase E, the stock or commodity leaves phase E we'll keep for tomorrow. So if you guys want to see episode 3, please let me know. I really enjoy doing these. I really enjoy doing the overnight radio show. So the more people that watch, the better. Even if it's just the same people, I don't care. I'll keep doing it for 50 people if you show interest. So let's go over our markets real quick. The Dow Jones was down 533 points right now, 33,290. The U.S. dollar index continues to go up for a 5th straight day at 0.46% to 92,321. Oil crude ends the week at up 0.43% to $70.86. Commerce Resources had a nice little rebound today, up 1.07% to 0.2174. That's our niobium mining stock. Very, very, very highly, should have a very high eye on that. I have 12,715 shares at the moment at 22 cents. Gold is at down 927 on the week at 1763. It had a horrible week. Just the news of Jerome Powell had actually hammered the gold, silver, and platinum markets, the commodities as a whole, and precious metals. Platinum was down $19.50 to end an absolutely horrible week, down to $1,034. Silver was down another 0.38% to $25.77, capping off a 15% loss this week. Fortuna Silver Mines was down another 2.50%, and it's getting absolutely hammered, down to $5.84, the lowest it's been in about 6 months. Copper's down another 1.09% to $4.12 a pound, and this is the lowest level it's been at all year, basically. Barrick Gold's down 1.33% to $20.75. You'd be hard-pressed to find this price in the last few months. This is the lowest level it's seen in some time. B2 Gold is down 3.32% to $4.37. As you guys know, I reopened my position in B2 Gold after selling at $4.82. I had 494 shares. I sold out at $4.82 after having an average position around $4.90. Sold out. I bought back 517 shares with the same money at $4.47. So I'm very happy about where I bought in. You're never going to buy the bottom, but this was an accumulating spot. And if it keeps going down, I'll accumulate more, but I'm going to continuously throw in. Like I said, my goal is to get the 10,000 in there with the 3.40% dividend now. So I've got about $2,300 in there. Kinross was down 3.89%, and it's absolutely getting hammered. It's down about $1.58 in the last week. The lowest levels this has been in about 3 months. Yamana Gold's down 2.46% to $4.36, and this is the lowest levels this has been in about a half a year. Hecla Mining is down another 5.40% to $7.54. I said this should be on your watch list, but it wasn't a buy at the time because their PE was way too high at 246.2, and I said it'd have to correct itself, and it's down about 27% in the last 10 days. AU's down 1.15% to 50 cents on the nose. It's really got a handle over the 50 level. Well, it doesn't. It's right on the money. That one's going to be one that you just buy right now. It's in the accumulating phase. And one day that's going to make it big in the short term rather than the long term. Just wait for the silver and gold markets to correct itself, which it's already doing. It's going to turn around in the short term. I call it the 10 days of hell before the 28th. Yamana, or where are we at now? GPL's up 0.24%, but it's absolutely getting shredded. It's down to it's up to 0.6747. But they had a mining collapse, so they absolutely got hammered. People are down about 23% on this over the last month and a half. But it was deemed unmineable because there was a severe storm out in one of their major mines. So by the end of the year, it'll be right back on track. So right now, you just got to eat it. But right now, you're getting a great bargain. So stock up on GPL. RDSA was down 5.26%. Like I told you guys, I only got like $45-50 in each of these two because I'm waiting. But I wanted to start a position so I wouldn't forget. Offers like a 5.65 dividend, but these are your foreign stocks that are on the foreign exchanges for when the stock market collapses. And then we got VOD was down 2.61% to $17.89. That caps off the week about 5 to 6% down. It caps off Royal Dutch down about 7.5%. So not terrible, but they're going to continue to drop with the market. So stay alert. I hope you guys enjoyed this overnight radio show. T-Speaker 222 XRP Future Millionaire with the side bet on XL and Future Digibyte OG. You guys be safe on your drive to work, or if you guys are going to bed, sleep well. If you want to join Tom's Army for $9.99 a month, links in the description. I highly encourage you to do this. Allow me to keep doing this content. If you want to make a donation, or tip Tom, as they would say, Links also in the description. Until next time, guys, stay true, stay blessed, and remember, guys, be good, do better. I want to see hashtag be good, do better in my chat. And if you want to see part 3, please let me know if you want to see part 3 of Wyckoff Schematics, because it's going to be lit tomorrow night at 3:42 a.m. So until tomorrow night, guys, at 3:42 a.m., the overnight radio show, you can get here each and every day, Monday through Sunday, at 3:42 a.m. Eastern Standard Time. Until next time, guys and gals, stay blessed.